$10,000 investment in the average mutual fund versus the same amount in a comparable ETF could leave you with nearly $2,000 less after 20 years. Same investments, different wrapper, massively different outcome. Let me show you why. I'm breaking down everything you need to know about ETFs versus mutual funds in 2026, because this decision affects every dollar you invest for the rest of your life. And most people get it completely wrong. First, let's get crystal clear on what these actually are. A mutual fund is a pooled investment vehicle managed by a professional fund manager. You and thousands of other investors put money in, the manager buys stocks or bonds, and you own a piece of everything. Mutual funds have been around since 1924. They're the old guard of investing. Your parents probably own them. Your 401k definitely has them. They've been the default choice for generations. ETFs, or exchange-traded funds, are the new kid on the block. They first appeared in 1993 and didn't really take off until the 2000s. But here's what makes them different. They trade on stock exchanges just like individual stocks. Think of it this way. Mutual funds are like ordering a custom meal that gets prepared once a day after the kitchen closes. ETFs are like a buffet that's open all day, and you can grab a plate whenever you want during business hours. Now let's talk about the first major difference, trading flexibility. With a mutual fund, you can only buy or sell once per day, after the market closes at 4 p.m. Eastern. You place your order, but you don't know the exact price you'll get. ETFs, you can trade them any second the market is open. 9:30 a.m., lunchtime, 3:59 p.m., doesn't matter. You see the exact price, you buy or sell instantly. For most long-term investors, this doesn't matter much, but it's there if you need it. Here's where it gets interesting. Minimum investments. Many mutual funds require anywhere from $1,000 to $3,000 just to get started. Some luxury funds want $50,000 or more as a minimum. ETFs. Most brokerages in 2026 let you buy fractional shares. You can start with literally $10, $20, whatever you've got. This is a massive advantage for beginners or anyone building wealth on a tight budget. Now we need to talk about the elephant in the room, fees. This is where mutual funds often get destroyed. The average actively managed mutual fund charges about 1% per year in expense ratios as of 2026. 1% doesn't sound like much, right? Wrong. On a $100,000 portfolio, that's $1,000 every single year. Over 30 years with compound growth. You're talking about tens of thousands of dollars gone. Compare that to ETFs. The average ETF expense ratio is around 0.4%. Popular index ETFs, like those tracking the S&P 500, as low as 0.03%. That's almost nothing. Let me put real numbers to this. $10,000 invested for 20 years at 8% annual returns. With a 1% fee, you end up with about $37,000. With 0.03%, you get $45,000, $8,000 difference from fees alone. But wait, there's more bad news from mutual funds. Many charge something called a load fee. That's a sales commission, sometimes 5% or more just to buy in. 5% off the top before you even start investing. No load mutual funds exist, and you should never pay a load fee in 2026. But tons of financial advisors still sell loaded funds because they get that commission. It's basically a scam. Avoid it completely. ETFs generally don't have load fees. You might pay a small trading commission, but most major brokerages eliminated those years ago. Fidelity, Schwab, Vanguard, they're all commission-free for most ETFs in 2026. Now let's discuss taxes, because this is where ETFs have a secret weapon that could save you thousands. Both mutual funds and ETFs distribute capital gains to shareholders. But ETFs are way more tax efficient in how they do it. Here's the problem with mutual funds. When other investors sell their shares, the fund manager might have to sell holdings to pay them out. Those sales create capital gains, and guess what? You get taxed on them, even though you didn't sell anything yourself. ETFs use something called an in-kind redemption process. Without getting too technical, this structure means they can avoid triggering capital gains when shares are bought and sold. The result? Way fewer taxable distributions for you. In taxable brokerage accounts, this is huge. ETFs might distribute almost zero capital gains year after year. Some mutual funds hit you with massive distributions annually. That's money you owe the IRS instead of keeping invested and growing. Of course, in retirement accounts like 401ks and IRAs, this doesn't matter because you're not paying taxes on gains until withdrawal anyway. So in those accounts, the tax efficiency advantage disappears. Let's talk about transparency. With an ETF, you can see exactly what stocks or bonds it holds, updated daily. You want to know if your ETF owns Apple or Tesla? Just check. It's all public information. Mutual funds only have to disclose their holdings quarterly, and even then, there's a delay. You might be investing in something for months without knowing exactly what you own. For some people, that lack of transparency is a deal breaker. Here's a big question. Which one performs better? And the answer might surprise you. For passive index funds and ETFs tracking the same index, performance is nearly identical. An S&P 500 mutual fund and S&P 500 ETF will track each other closely. The performance difference comes down to those fees we talked about. Lower fees mean better returns, period. This is why low-cost index ETFs have been crushing expensive, actively managed mutual funds for years. Speaking of active management, here's an uncomfortable truth. About 90% of actively managed mutual funds fail to beat their benchmark index over 15-year periods. 90%. The fund manager earning millions? Usually not worth it. There are actively managed ETFs too, by the way. They exist, and they usually charge higher fees, just like active mutual funds. And guess what? Most of them underperform too. Active management is tough regardless of the wrapper. So, when would you actually choose a mutual fund over an ETF? There are a few legitimate scenarios. Some 401k plans only offer mutual funds. You don't have a choice. Take the lowest cost index fund options available. Automatic investing is easier with mutual funds at some brokerages. You can set up automatic purchases of exact dollar amounts. With ETFs, you're buying shares, which can be slightly more complicated for automation, though this is changing in 2026. Some specialized strategies or asset classes are only available as mutual funds. Certain small-cap value funds or specific international strategies might not have ETF equivalents, but this is becoming rarer every year. If you're working with a financial advisor who has access to institutional share classes of mutual funds with super low fees, that could work. But make sure those fees are actually competitive with ETF alternatives. For most people investing in 2026, ETFs are the superior choice. Lower fees, better tax efficiency, more flexibility, lower minimums. The advantages are overwhelming for individual investors building wealth. Let me give you my personal strategy. My taxable brokerage account, 100% low-cost index ETFs. I'm talking Vanguard VO, Schwab SCHD, things like that. Expense ratios under 0.1%. Incredible tax efficiency. My 401k through my employer, I have to use mutual funds because that's what's offered. So I choose the index fund options with the lowest expense ratios available. I'm not paying 1% for active management nonsense. Here's what you should do right now. Look at your current investments. Check the expense ratios. If you're paying more than 0.2% for basic index exposure, you're probably overpaying. Consider switching to lower-cost alternatives. If you're in taxable accounts with high-cost mutual funds that spit out capital gains every year, you might want to gradually shift to tax-efficient ETFs. Talk to a tax professional about the best way to do this transition. One warning, don't go crazy trading ETFs just because you can. The fact that they trade like stocks doesn't mean you should day trade them. That's a great way to lose money and rack up taxes. Buy, hold, and let compound growth work. Also, not all ETFs are created equal. There are leveraged ETFs, inverse ETFs, and other exotic products that are basically gambling instruments. Stick with boring broad market index ETFs. Boring makes you rich in investing. The best ETFs for most investors in 2026? Something tracking the total stock market, the S&P 500, or a diversified global portfolio. Add some bond ETFs if you want stability. Keep it simple, keep fees low. Let's talk numbers one more time. Someone investing $500 a month for 30 years in a mutual fund with 1% fees versus an ETF with 0.04% fees. The difference? Over $120,000. Same contributions, different outcome. That's not even counting the tax advantages. Add in the fact that the ETF investor paid thousands less in taxes over those 30 years, and the gap gets even wider. We're talking about a potentially life-changing amount of money. The investment industry doesn't advertise this stuff because they make way more money on expensive mutual funds. That 1% fee, that's their profit. They're not incentivized to recommend a cheaper, better option. This is why financial education matters so much. When you understand the math, you can't unsee it. You realize that most of the complexity in investing is manufactured to justify high fees. The truth is simple: low cost, diversified long-term. If you found this breakdown valuable, do me a favor and smash that like button. Subscribe to Operation Wealthy if you haven't already. We cut through the BS and give you actionable strategies to actually build wealth. Bottom line, unless you have a specific reason to choose mutual funds, ETFs are the better vehicle for most investors in 2026. Lower fees, better tax treatment, more flexibility, and easier access. The choice is clear. Don't let another year go by paying unnecessary fees and taxes. Review your portfolio, make the switch if it makes sense, and keep more of your money working for you instead of Wall Street. That's how you win the investing game. Thanks for watching Operation Wealthy. Check out the next video where we're breaking down the exact ETFs I personally invest in and why. I'll see you there.